Hotel pre-opening OPEX strategy is one of the most critical yet frequently underestimated components of a successful hotel launch. Many developers approach this phase with a cost-cutting mindset, assuming that minimizing expenses will protect their investment. In reality, successful OPEX management during pre-opening is not about cutting costs to the minimum. It is about achieving a strategic balance between cost control and revenue readiness. This balance is what determines whether a hotel stabilizes quickly or struggles to gain traction in its initial months. Pre-opening OPEX covers all operational expenses incurred before the hotel starts generating revenue. This includes staffing, training, marketing, system setup, trial operations, and administrative costs. The challenge is that these expenses occur without immediate income, making financial discipline and planning essential. However, underinvestment in this phase often leads to operational inefficiencies and lost revenue opportunities post-launch. Starting with the do's, the first priority is to align OPEX with operational readiness. Every expense during pre-opening must have a direct connection to the hotel's ability to deliver service from day one. Recruitment should be planned based on actual operational requirements, not assumptions. Training programs must be comprehensive enough to ensure that staff are fully prepared to deliver brand standards and guest expectations from the moment the hotel opens. Second, prioritize revenue-driving functions early. Sales, marketing, and distribution channels should not be treated as optional or delayed investments. A hotel that opens without strong market visibility or booking channels in place starts at a disadvantage. Pre-opening marketing campaigns, digital presence, channel partnerships, and sales outreach must be adequately funded and executed in advance to ensure a pipeline of bookings at launch. Third, develop a realistic working capital plan. Hotels do not achieve optimal occupancy immediately after opening. There is always a ramp-up period where revenues gradually increase. Your OPEX strategy must account for this by ensuring sufficient working capital to sustain operations during the initial months. Underestimating this requirement can lead to cash flow stress and compromise service delivery. Another critical aspect is cost tracking and accountability. Every pre-opening expense should be monitored against defined outcomes. Whether it is training effectiveness, marketing conversion, or staffing efficiency, linking expenses to performance ensures that resources are being utilized effectively and not wasted. Now, moving to the don'ts, one of the most common mistakes is aggressive cost-cutting in critical areas. Reducing expenses in staffing, training, or guest experience may lower initial outflows, but it often results in poor service quality, negative guest feedback, and weak brand positioning. These issues are far more expensive to fix after opening than investing correctly in the first place. Another key mistake is underestimating the pre-opening timeline. Delays in construction, licensing, or system readiness can extend the pre-opening phase, increasing PX without generating revenue. A well-structured strategy must factor in potential delays and include financial buffers to manage extended timelines. Overstaffing is another frequent issue. Hiring too many employees too early leads to unnecessary payroll expenses without corresponding operational demand. Staffing plans should be phased and aligned with occupancy projections to maintain efficiency without compromising service. Additionally, treating OPEX planning as a one-time exercise can be detrimental. Pre-opening is a dynamic phase where plans need constant adjustment based on project progress, market conditions, and operational readiness. Regular monitoring and recalibration are essential to ensure alignment with actual requirements. Finally, avoid disconnect between departments. Pre-opening OPEX strategy must be coordinated across operations, finance, sales, and human resources. Lack of alignment often results in duplicated efforts, inefficient spending, and gaps in readiness. In conclusion, hotel pre-opening OPEX strategy is about disciplined investment, not cost minimization. The right balance between controlling expenses and enabling revenue generation is what sets the foundation for a successful launch. Hotels that manage this phase strategically are able to enter the market with confidence, achieve faster stabilization, and build a strong base for long-term profitability. Those that fail to do so often face operational challenges and financial strain from the very beginning.